Good morning. I see we have quite a few of our participants with us this morning, and I wanted to say welcome to you. I am Susan Hunt. I am the Vice President and CFO of the Catholic Foundation. And I want to welcome you. And you can see this is a picture of Kimberly and I. Kimberly unfortunately couldn't be with us today. She's at home recuperating from a small accident, but has full confidence that we're going to go forward and do this without her. But she does send her best wishes, and thanks those of you who have been praying for her. We really appreciate that. I do have a couple of housekeeping announcements as we get started. If most of you, it looks like your microphones and video are off, and I thank you for that. If you can keep them off, it kind of improves the bandwidth for our speakers. And we would really welcome any questions you have. In order to make it the most efficient as possible, we'd like you to type those into the chat area, and we'll be monitoring that and make sure those questions get asked and answered. I want to thank our presenters today. We have John Bolton from the Concord Advisory Group, Dane Smith from State Street Global Advisors, that's hard to say, and Madeline Weed, who's with our own Catholic Foundation. So we expect the webinar to run about an hour, and we want to be respectful of your time. So if we could, we'd like to begin with a prayer of St. Catherine Drexel, who is our patron saint of philanthropy. So join with me if you would, in the name of the Father, Son, and Holy Spirit. Heavenly Father, you are the giver of life, and everything we have is a gift from you. You have shown us your infinite generosity by giving us your Son, Jesus Christ. You inspired St. Catherine Drexel to dedicate her life and selflessly share her treasures with those in need. May her example help us to be faithful stewards of your abundant gifts. Teach us to be cheerful and grateful givers so we can bring our world to its fullness of charity. We ask this through Jesus Christ our Lord. In the name of the Father, Son, and Holy Spirit. Amen. So we have a couple of slides quickly on the Catholic Foundation. I know today we have our diocesan investment partners here with us, so you are familiar. The Catholic Foundation is a separate 501c3, and we are happy to have the endorsement of the bishop, as you see. We serve the diocese. That's our mission. Our reason for being is to be here to serve the diocese and its entities. We do that in three different ways: through community services, which some of you may be very familiar with, our Catholic Appeal, Offertory Enhancement, and Capital Campaigns. That's true for both schools and for some of our parishes. We also have donor services, which is a newer service, and Madeline's role today kind of falls in that area as we look at how to do endowment building. But really, it's about working with our donors to determine what is on their heart as far as giving and help them make those dreams of theirs of philanthropy a reality. And last but not least, because this is my area, is investment and asset management. What we do is provide an investment vehicle for diocesan entities that is completely screened for Catholic social values. We have endowment and reserve funds and donor advised funds. So before we move on to our first presentation from Concord, we have a poll question. Our participants today, if you would answer this. Carolyn, if you would introduce the question.
So since all of you have endowments or reserve funds with us, if you could just answer how often you at the parish or members of your finance council check your endowment or reserve funds just to see how they're doing with their performance, whether it's monthly, semi-annually, or annually. So monthly looks like how often usually check on that. Thank you for sharing.
That's great. So you guys are looking at that on a regular basis, and I'm happy that we are able to provide monthly investment statements now, which has been an improvement for us. So I'm ready. I think we're ready to move on to John Bolton is the Senior Consultant of Concord Advisory Group. I'm going to let John tell you a little more about Concord, but I'd be remiss if I didn't tell you what a great partner they've been to us at the foundation and really to our investment partners. They've helped us devise all the different investment options that we offer. They help us with the Catholic social values screening, which is wonderful and available for us and our partners. And they've always been available to meet with us and with any of our investors who have a question or potential investors. So John is one of our primary contacts, but Scott Santine, who's their managing partner, who also couldn't be on the call today, have become almost members of our extended staff. We try to tell them, but they would like to be called members of our extended team, probably. So, John, I'm going to pass this over to you.
Great. Thank you, Susan. I appreciate that introduction, and good morning, everyone. Good to be with you. I'm glad you didn't put daily as an option on the poll question in terms of checking returns. So thank you for that. But if you could just turn to the next slide, give you a brief introduction of Concord, who we are, how we work with the foundation and the diocese. Then we're going to spend a little bit of time just reviewing some recent market activity, comments, some of the data that we review with the foundation's investment committee, and then talk a little bit more about the structure of the foundation investment program and sort of the governance in place to make sure the assets are properly overseen. So just first about Concord, we are a independent investment consulting firm, been around since 1988. And giving independent, non-conflicted advice is really our only business. We don't have any other services or revenue streams. You could see in the middle of the page, we have approximately 117 client relationships, 36 billion, and we work almost exclusively with nonprofits. And within the nonprofit space, more than half of our clients are religious affiliated, many Catholic dioceses and women congregations as well. So it's a space we work in and have a lot of experience in. And we've been with the foundation, let's say 7 or 8 years at this point, but we've been working for the Diocese of Orlando for over 20 years. So we know the program and know the background well. If you turn to the next slide, just to give some recap of sort of last year, and I'll be brief here. I know Dane from SSGA is going to be spending some more time talking about market dynamics and some forward-looking thoughts, but really just looking back at 2020. Hopefully you can see some of the numbers on this page, but despite everything that went on in the world, the non-investment world, which was obviously an extremely challenging year, investment markets turned out to have a very strong year, both on the equity and on the bond side. And there's a few reasons for that. But if you look at the left-hand side, the S&P 500, you can see for the full year, the S&P 500, which is the broad US equity market, was up over 18%. And as you go down that year-to-date column there, again, you see generally double-digit positive returns across the board. What makes it even more remarkable is really, if everyone remembers, in March of last year, the significant sell-off we saw in stocks. And as the Federal Reserve and government came in and really responded to help stabilize markets, it was really a straight upward line for the last 3 quarters of the year. Similarly on the fixed income side, on the right-hand side of the page, you can see the Barclays Aggregate Index. This is the broad U.S. fixed income market for the year, was up approximately 7.5%. And this is really a function of the Federal Reserve lowering interest rates. As interest rates come down, it has a positive inverse effect on fixed income returns. So you can see across the spectrum there, really mid to high single double-digit returns for fixed income. So despite the challenges that all of us have faced over the past year, the investment markets and the foundation really performed quite well. So if you turn to the next page, please. A lot of clients ask us, we just had this outstanding year, fixed income rates are low, markets appear to be high or at near all-time highs. So where do we go from here? And we think there's a case to be made for long-term investors like the foundation to maintain the equity allocations despite the strong performance we've recently seen. This chart here really reflects the amount of stimulus both in the US and across the globe that came about in response to COVID over the past year. You can see globally close to 30 trillion in stimulus, both on the fiscal and monetary side, has been entered into the system, so to speak. And if you look at the US, we're at close to 10 trillion and counting. We all know there's another significant legislation that's in the works now, and the details are being ironed out. This is unprecedented, both the size and scope of this response, and it does a few things. Again, on the in terms of being a tailwind for risk assets, we think these activities of pumping money into the system, stimulating financial markets, that is a natural tailwind for equities, for risk assets. And if you go to the next page, in terms of the investment landscape, the Federal Reserve in the US has basically telegraphed that they expect to keep interest rates at the 0% level for the next few years. You can see at least for the next 3 years is what the market projects. Outside of the US, that's even longer. So you think about this environment where the opportunity set within bonds is not great if you're trying to earn competitive returns. And there's stimulus that is there to really support risk assets to incent investors to take risk. And then lastly, on the next page, the pandemic 2020 really has changed and transformed how all of us operate on a day-to-day basis. But for companies, for large companies, you can see this chart shows that productivity has really boomed over the past year. And really, there's a few reasons for that, but primarily, a lot of companies over the past year have really accelerated their reliance and use on technology, right? We all know Zoom, like we are right now with Zoom and other virtual meetings. Companies are using technology a lot more than they've had to in the past. In general, that's a good thing for productivity, for profits. It's able to take costs down. They also have access to extremely cheap debt based on where rates are. So again, significant stimulus, 0 interest rates, and companies are more profitable. I think this is generally going to be a recipe to keep allocations to stocks for long-term investors like the foundation. So I'll pause there. That was hopefully not too long of a recap of markets. And I know Dane's going to go into it a bit further, but did also want to spend some time talking about the investment program of the foundation, how it's structured, and who the key players are. So you can see on this page, the foundation investment program, over time, we've developed really 3 different portfolios, the 3 to 5 year, the 5+ year reserve portfolios. And I know Madeline's going to speak a little bit to this later in her slides, but these are intended to be just that, reserve portfolios that parishes, schools still have access to make withdrawals from. And then on the far right, the permanent endowed portfolio, which is where the bulk of the assets of the foundation reside, tends to have the highest equity exposure, highest risk profile, but also the highest expected return moving forward. And as the title of that portfolio indicates, it's really intended for truly permanent, long-term endowed assets. And the reason these portfolios were designed this way is this text at the bottom, that we strongly believe that the most important decision, the biggest contributing factor to future investment returns is the asset allocation, how much stocks, how much bonds you have in the portfolio. So to really simplify the decision for parishes and schools within the diocese, we really ask them to identify or make one decision, and that's how long are these assets going to be invested for? What's the time horizon? That's how these pools have been designed. If you turn to the next page, you can sort of see some of the reason why time horizon is so important, especially for the permanent endowed portfolio. We show on this page annually, going back to 2013, the top line, the annual net of fee return for the permanent endowed portfolio. And you can see in any given year, there's a wide range of outcomes, which should be expected based on the equity exposure in the portfolio. Some years have been up double digits. Fiscal year to date so far is up 18%. And there's other years where returns are muted or negative. And the reason we show this is that over the long term, you go all the way to the right, since 2013, portfolios earned about 8.4% per year annualized. And again, this goes back to the most important thing we can do is making sure that participants in the foundation have that time horizon set correctly so that expectations can be managed and they're able to ride through the ups and downs that the market have in any given year and focus on the long term. You jump ahead 2 more slides, 1 more, there we go. So just to give you a sense of who the key players are, the strategic partners of the foundation. I described our role, Concord. We're the advisors, the investment consultants. You can, as Susan so nicely put, really view us as an extension of their team, and we help oversee the entire investment program. Dane, who's from SSGA from State Street, they are an asset manager, an investment manager. They manage a portion of the portfolio, the US equity large cap portion. You can see them on the upper left of this page, but all these other firms are the asset managers that all manage some component of the portfolio, some equity, some bond. Some of the names you probably recognize are some of the biggest firms out there, and it's a mix of the largest firms and then some independent boutiques as well that specialize in a particular area or asset class. As Susan alluded to, one of the benefits we think of this foundation is that there's direct access to folks like Dane and his team at SSGA. We've had other firms come in and present at these type of investor conferences, at investment committee meetings. We think that's important, that sort of collaborative type of environment. And importantly, the portfolio, as Susan mentioned, is socially screened. So these firms are judged and evaluated in managing their particular pool of assets in a manner that's consistent with Catholic teachings. And it's something we look at on a regular basis with the investment committee. And happy to report that at the most recent analysis, more than 99.5% of the portfolio was compliant with Catholic teachings. So it's important. And the last comment I'll make here is that as the foundation has grown, like I said, we've been here 7 or 8 years. Started out under 10 million, now 70 million and counting. And I know that growing at quite a good rate. That's a benefit to all entities within the investment program. As the assets grow, that allows access to cheaper strategies, so costs come down as scale goes up. And then it also allows access to different investment strategies. So again, that's a process that's ongoing. But again, this is the team, this is the roster. It's, I think, one of the primary benefits of the foundation. And then lastly, just to give a sense of, it's not just us and Susan and her team making decisions. There's a pretty robust governance structure in place in terms of overseeing the investment program. So you can see on the diagram, the chart here, Concord, we meet on a regular basis with the foundation's investment committee. Those meetings are done quarterly, and depending on market conditions and what's occurring, there's more frequent communication. We dialogue with Susan, Kimberly, and their team really on a day-to-day basis to handle issues related to the portfolio. And then there's also the diocese, the Diocesan Investment Committee overseeing this pool. So as investors or potential investors in the program, you should take a lot of comfort knowing that there's a lot of oversight and governance and process in place. And I think the best example of how this is a benefit is really going back to recent memory, to March of last year, when markets were selling off in March and nobody really knew what was going on with the virus. You know, there was regular communication, dialogue with the investment committee, and really just making sure that we stayed the course, that people didn't panic and take money out, etc. And we all know the benefit that had of, you know, experiencing the rally towards the end of last year. So anyway, we're here to serve. We're proud to be a partner of the foundation, and you know, I think the structure that's been built over time is really beneficial and best in class. So I will pause there. I don't know if we want to do questions at the end. Susan, happy to take any now. But if not, I would turn it over to Dane.
Thanks, John. This is Susan again. Does anyone have any questions? I know, John, one of the questions that we get, and I have to softball it to you, is what do you expect for the next 3 to 5 months, 6 months perhaps? Because folks now on this call are thinking about distributions and budgets for the upcoming year. Our advice always is, and you can correct me, is looking at where we are now, it looks like a good normal year, but there's no telling what could happen, as we saw last year during our last round. So we usually advise folks not to budget a distribution, and for most of our entities, it's not a huge amount at this point, although it can get to be a very significant amount, as Madeline will talk about. Would you agree to that, or do you have any thoughts about? I remember from your presentation, it sounds like you're expecting a relative stability in the next short term based on some of the stimulus and interest rate issues.
The short term, thanks, Susan. The short term is extremely difficult to project. And we try to not do so for a number of reasons. And we've already seen this year, volatility, as you've seen a rise in interest rates, and that's sort of spooked markets and concerns over inflation. So very hard in the near term to project what's going to happen over the next few months. I will say that for the fiscal year ending June 30, 2021, results have been quite strong so far, right? In terms of, double-digit type of returns fiscal year to date. So we would certainly exercise caution in projecting. I think it's probably safe to assume or budget out a flat environment between now and the end of the fiscal year based on where things are and the strong returns experienced thus far. I think that's probably the conservative approach.
Thank you. That, of course, appeals to my conservative accounting self. So
Sure.
I appreciate that.
Sure.
So next up, we have Dane Smith of State Street Global Advisors. SSGA is the investment arm of State Street Global Corporation and the world's third largest asset manager. They have nearly $3.5 trillion in assets under management. SSGA has a comprehensive approach to values-based investing, which has meshed really nicely with our Catholic social screening. They employ 2,500 people in 28 countries around the world, and we're very happy to have one of them here with us today. Dane is a vice president and investment strategist with SSGA's Investment Solutions Group. And Dane, thank you so much for taking time to be here with us today.
Thank you, Susan. Thank you for the introduction. And John, thanks for the comments. I always appreciate hearing peers' comments on markets. And so with that nice introduction, my intention today is to spend about 10 to 15 minutes talking a little bit about markets. Some of the comments I'll make are going to sound very similar to some of the comments that John has made already. But, we always talk about diversity of thought as being one of the bedrock, being a bedrock of financial markets so that we can get a good understanding of where we think the markets may be going. So some of this stuff is going to sound familiar, maybe based on John's comments. Maybe I'll have a slightly different spin, and hopefully it puts some of the market dynamics that we've been seeing lately into perspective. So I'm going to begin on slide 20. And it's as John has alluded to, it's very difficult to think about markets in today's environment without having a very good understanding of what is happening in rates. And as for the reasons mentioned earlier, in dating back to their last crisis, not the pandemic, but the crisis that happened in late 2007, 2008, the global financial crisis, we entered into a period in the last cycle where we've taken into the system a very, very accommodative approach to monetary policy, which is sort of a fancy way of saying interest rates became low and have only gotten lower. Now, that has had impact on many different aspects of the market. But all of this quantitative easing has certainly led to, many of the dynamics that we're seeing today in terms of high valuations in equities and very, very low yields in US bonds. And those two dynamics really begin to help us characterize how we make decisions for our portfolios and how we start to make decisions for our clients. So you have high valuations in equities in the US, and you have very, very low bond yields that help make bond prices high. But, one of the main roles of bonds in a portfolio isn't necessarily price appreciation. It's more about income and allowing income to come into your portfolio. And because yields are so low, the income component of the bond investment has been challenged. Slide 21. And this is not just a US trend. Because of these low to negative bond yields and low yields in the US and negative bond yields in Europe, Germany and the UK experience negative yields at certain points, as well as Japan, whose yields have been close to zero for a very long time. Yield is a challenge for any investor in the marketplace and in many of the different segments that you may go to find it. So not only are US bonds yield challenged, but global bonds are also yield challenged at the moment, creating a very interesting dynamic for the role of bonds and its usefulness when we think about developing asset allocation portfolios. Next slide. So this has an impact on how we make decisions on our hedging portfolio, or the assets that are in the portfolio that are designed to help protect our growth assets. So when equities do poorly, you tend to think of your bonds as performing well. But bonds are challenged, as I've just mentioned. So when we think about developing a bond allocation, we think about the amount of quantitative easing that's come into place and what that means into the future. Now, rates have been low for a long time, but in the most recent months, we've started to see a back up in rates. It's slang a little bit for those that sort of spend a lot of time in the markets, but it's really a literal translation. Rates are moving back upwards. So we're seeing a backing up of rates. And in fact, in the US, we've added close to 40 to 50 basis points of yield back into the 10-year treasury in the last month and a half, which is a new dynamic that we haven't seen from bonds in some time. Even still, with bond rates backing up, this creates a bit more of a favorable environment for credit. So for investors that need to be in bonds and have a very difficult time understanding what their view is on rates, credit in fixed income markets help provide a nice relative place to invest. And the reason why is that credit is being supported by the Fed and a lot of the accommodative policy that I've just previously discussed. And so instead of owning a treasury, you may own a corporate bond instead. And it should be of similar investment grade quality. But the benefit is it likely provides you with more yield. Another impact of the rate environment on fixed income assets is the hedging costs that go into making US credit attractive. And so you have a lower hedging cost, as I mentioned earlier, in credit relative to your growth assets, your equity assets in your portfolio. And finally, on the bond side, because we've seen rates backing up and because we've seen the prospects of inflation coming back into the system due to this reflation trade, as many are calling it, we can start to see support in the market for assets that have been out of favor now for quite some time. And those assets have been commodities, commodity-based assets, such as energy, real assets, and gold. And gold certainly had a fantastic year in 2020. And I know it's gotten off to a bit of a choppy start this year in 2021. But we can see pockets of this trade materializing. And I would point to energy and energy names as being one of those areas where commodities have begun the year on a pretty strong note on the backdrop of inflation and the role of inflation coming back into the system a bit. Next slide. Shifting gears slightly, low rates and low yields are not just a phenomenon that impacts the fixed income portfolio. It also impacts what's happening in equity markets. And so, easy monetary policy and accommodative fiscal policy have led to what I'm showing here as a fantastic run for equities. And if you've been an equity investor, as I know you have, for the past few years, you've likely experienced very, very strong returns, especially in the US large cap segment of the market, where large technology names have really, really done well. And they've been able to do well because they've been able to take advantage of this accommodative monetary policy. They can borrow at very low rates to help feed high earnings multiples for their organizations. But we can't expect that to last forever. And on the next slide, I am foreshadowing what we think is going to be very important for equities as we move forward throughout this year. And that is the earnings picture has to follow suit. And what I'm showing here is that these dark, deep blue lines show how equity markets have performed over the past 3 calendar years. And the punchline here is that most of these markets have performed well on the backdrop of a change in their price to earnings ratio, which is a valuation metric that helps to describe that these companies have expanded on the basis of higher valuations, but not necessarily on attractive earnings or real revenue that they've brought into their organizations. And so what we believe needs to happen for equities to continue to do well this year is that the earnings picture needs to follow suit. And companies need to start putting up good earnings calls on a quarterly basis in order for equities to continue. Now, the good news is we've almost completed the 4th quarter of last year's earnings calls, and it's been a very favorable backdrop so far, which is a good beginning for us as we look out into this first half of the year. Finally, we examine on the next slide what we believe could happen or could be a favorable backdrop for equities this year. So the equity risk premium continues to be favorable to equities, which is the premium that you get in investing in equities relative to bonds. And we see that there's still a healthy spread to be had there. But as I mentioned, earnings growth must continue to follow suit. When we look at what segments of the equity market we favor, we continue to favor growth assets because we believe is so long as that rates stay low, growth assets, and that is sort of a different way of talking about the segment of the market that has shown higher growing multiples in their business. So you can think of these names as Apple and Facebook and Tesla. We continue to see these types of names doing well, but as I mentioned in my final comments on this slide, there is an environment that exists for value to come back into favor too. As the reflation trade continues, as segments of the economy come back online post-pandemic, we believe that areas of the market that have been hurt the most by COVID, that have been hurt the most by being out of favor, just in terms of their business models, in terms of the industries that they they do business in. We believe there's an opportunity there for those names to come back. And actually, we see this recently in the current market dynamic. This past month of February was a pretty good month for equities, with the exception of the last week of February. And that was where we really had one of the bigger moves back up in rates. And what we saw happen to the market during that past week was that these growth names, these big technology names, sold off pretty hard. But some of the underappreciated segments of the market did pretty well. Financials being one of them, materials and energy being another. And those names are most closely associated to value. So that is a trend, and that is a dynamic that we're going to continue to watch very, very closely as we move throughout the year. And as John alluded to before, it also may be the source of some volatility, some episodic bouts of volatility as we kind of continue to move through the year. What happens in rates will be a good indicator of what then may follow in equity markets. And finally, on slide 26, I wanted to give you a little bit of a view into how we're thinking about our tactical asset allocation positions. Now, John spent quite a bit of time talking about strategic asset allocation considerations, and he is right in saying that asset allocation and time horizon are probably the two most important aspects of any strategic asset allocation portfolio. Susan then mentioned, what can we expect for the next 12 months? That sort of is more of a tactical type question. And here on this slide, I'm showing you what our tactical views are at SSGA as of the end of January. So these are a little stale, but not materially so. And so as you can see in this portfolio here, anything to the right of the axis, any of those browner lines that are moving off to the right, are where we're overweight these positions. These are assets that we favor at the current point in time. And so you can see where we favor US large cap equities. You can see where we favor US small cap equities to begin the year. We also favor equity in general, but a little bit less so in the Pacific region and a little less so in emerging markets, but we're overweight nonetheless. And then on the bond side of the equation, you can see where we're taking on some credit risk in our portfolio. And this mirrors the comments, as you might naturally expect, that I made earlier in this presentation. So we see a favorable market environment at the moment for credit. So non-investment grade as well as investment grade credit. And we also see a favorable environment for commodities-based assets, where we have at the bottom of this slide, bottom of this table, I would call these healthy overweight positions to commodities in gold as well. So this slide helps answer Susan's earlier question somewhat, and it gives you a bit of a sense of how these market dynamics are impacting the investment decisions that we're making in our portfolio today. So I've gone for about 15 minutes as promised, and I'll pause my remarks there, and I'm more than happy to answer any questions on any of the information I've just presented, or as an investment strategist that's multi-asset class oriented, I'm happy to answer any questions that I may not have, answer questions on material that I may not have presented here as well, but I'll take a pause here.
Does anyone have any questions? One thing I was going to mention, Dane, is that our fund with you is an index fund for the S&P 500. So it's interesting to think about the fact that all of those positions on that last slide really probably come more into play for that fund as hedging, trying to make sure that you achieve the growth that you want by making sure you have diversification and have the right asset allocation. So just to confirm for our folks on the phone today and on the Zoom, we really do have an index fund, but these things are, I guess, playing into the background at SSGA on how you position the whole firm to make sure that those results are achieved, correct?
Yes, that's exactly right, Susan. So, you have through Concord and through John's guidance, you have portfolios that take longer term views. They're designed to be more strategic in nature. And, the fund that we manage on behalf of Concord and yourself is a U.S. large cap fund. And, that plays a very, very important role in the growth of your assets over time. And time in this instance is a very long time horizon, right? We hope that your organization, is managed into perpetuity almost. And so that's the role that particular fund's playing. You're right to say that many of the other assets that I show on this slide do serve as diversifiers to U.S. large cap equities. And in the case of the bond portfolios that I'm showing below, those would be portfolios that we would use to hedge a portfolio like the U.S. large cap portfolio. So yes, you're absolutely right. These views are sort of more short term on this slide. They're short. They're to give you a sense of the dynamic nature of the markets. But you're completely right in saying that large cap U.S. fund is more long term. It's more strategic, and it's a good allocation to have for those that are looking to manage assets long into the future.
And we hope we're all around for perpetuity. So let's try to make sure that we are with these investments that we have. Well, I'm going to move ahead then and introduce Madeline Weed, who is the Foundation's Vice President and Chief Donor Services Officer. Madeline has been with the Foundation since October of 2019. I think I have that right. See, sometimes it seems like people have been here forever because they do such a great job. Madeline came to us after serving 18 years at Marmion Abbey and Academy in Illinois as Executive Director of Advancement. And in her short time here, she's really made a huge impact on our operations by developing our new donor services area, or enhancing that, and adding different offerings and special gift and legacy planning. So Madeline, thank you for joining us today, and let's start your presentation with another poll question, if Carolyn could pop that up for us.
So for our second poll question, we're just kind of looking at your how you build your endowments. So if you could just answer, our parish school or actively adds contributions to build our endowment or reserve funds each year. Yes, no, or not every year. Looks like not quite every year, but you have added some funds to that. So thank you very much.
Thank you, Susan, for that very nice introduction. It's good to see that a majority of people are adding to the fund at some point. So that's good news. We're going to talk a little bit more about that today. I'm really happy to have the opportunity to speak with you about endowment and reserve fund building. I'd really like to touch on and put us in the frame of mind of financial wellness. So financial wellness is really having control over your finances and having the ability, the capacity to absorb a financial shock. When air conditioning goes out or roof needs replacement, you never know when that's going to happen. And that's really where endowments and reserve funds can make an incredible impact. I want to touch on really the differences between endowment funds and reserve funds. I know many of you, everybody has an endowment fund, and I think we have one or two reserve funds, but we have questions all the time about the difference between the two of these. So I wanted to start off with this. So an endowment, as you heard earlier, really endowed in perpetuity. So a donation or the money used to start the initial deposit of an endowment fund is there forever. So that those dollars form the principal or the corpus of the fund, and those remain intact, or that's the goal for that fund, so that it can grow and throw off revenue streams now and into the future forever, God willing. The principal is invested for growth, and with us, it's invested in socially responsible investments, Catholic compliant investments, and then a percentage of the earnings from those funds are available annually. And we recommend between 3 and 5% on an annual basis. Additional gifts can be added to the principal really at any time, and that allows the fund to grow and increase your earnings in perpetuity, ensuring the long-term financial wellness of your ministry. Now, with a reserve fund, It's the same but different. The same in the fact that those funds are invested for growth in socially responsible Catholic compliant investments, but different in the fact that really those funds are 100% available to you when ready. So John talked about the importance of choosing a time horizon. So with reserve funds, we have 2 time horizon options, our portfolios. Short-term reserves, which is 3 to 5 years. So you have some dollars that were donated or that you want to put aside for a project that might start in the next 3 to 5 years, and you want those funds to grow while you have them. And investments are a great way to do that. So you put that in a short-term reserve, let it grow for 3 to 5 years, and then 100% of those funds and all of the growth are available to you after that 3 to 5 year period. A long-term reserve is really a 5+ time horizon. This is a perfect option for deferred maintenance. You want to start thinking now about that capacity to absorb an unexpected financial shock. And a long-term reserve is a great option. You have those funds, you put them into a long-term reserve. And again, you really have 2 options. One is a reserve fund where 100% of those funds plus earnings are available to you. The other is a quasi-endowment. And a great option for this is a donor who wants to give funds to you, let's say $25,000. And they want you to invest that, they want the funds to grow, and they want a majority of those funds or a portion of those funds to be available for your use after a growth period. But they also have a desire to leave a long-lasting legacy in their name, the name of a family member, so that those funds could continue to support your ministry into the future. So let's say they take $20,000 of that and they say, okay, invest this, and then those funds are going to be available for your use. But I want to reserve $5,000 of that and endow that in perpetuity, and that money can throw off support for your ministry in perpetuity. That's really what a quasi-endowment is. And that's a nice option for a reserve fund and a beautiful option for a donor who wants to make an impact now and into the future. So really difference between endowment funds, endowments perpetually endowed corpus, reserve funds, those dollars are yours and available to you after a time opportunity for growth. So any questions before I move on regarding the difference between an endowment fund and a reserve fund? Okay, well, we'll move on. If anybody has a question, always feel free to pop it up. So what are the benefits of endowment and reserve funds? As I just mentioned, they create current and future streams of income. It allows you the ability to leverage charitable dollars with market growth. In our case, with Catholic compliant investments. This enhances the value of a gift, a value of your dollars, and the impact of those dollars over time. The attention you put into endowment building signals to your community that you're planning ahead, that you're fiscally responsible, and you're building necessary assets for future sustainability. It shows that you're dedicated to the long-term support of your mission and your ministry. And it also encourages continued giving. We know that donors who make an endowment gift, whether it's now or through an estate plan, a bequest gift, they're more likely to make additional larger gifts to offertory appeals campaigns now, because they've already made a long-term commitment to your organization's future. So I want to talk for a moment about annual distributions. As all of you have endowment funds, you've seen this idea of what an annual distribution is, and I'm sure you know what your annual distribution could be. But really, as your fund grows, so do your annual distribution. So the chart shown here shows the difference between a fund market value at a different value amount and those annual distributions. So it can go with a fund like $20,000 fund with an $800 annual distribution up to what we have seen possibly a $400,000 annual distribution. But the chart goes up to $1 million market value, and that equals out to about a $40,000 annual distribution, and that's really wrapped around or based on a 4% drawdown on your earnings. Last year, funds held with the Catholic Foundation range from that $400,000 distribution, wouldn't that be nice, to a few $100s. And I know we have a couple people on the call who reinvested their earnings. They didn't need those maybe $2,000. So they reinvested those into their fund for future growth, which is beautiful. And about 25% of our fund beneficiaries did that in 2020. Okay, so the next slide shows a little bit more about fund growth. So let's say you start out with a $20,000 gift. You start your fund at $20,000. If you let those funds grow and you add a mere like $1,000 a year, this could be from a donor, it could be a grouping of donations through a special appeal, a second collection, and you add those to the fund and you don't touch it other than that. Over a period of 20 years, you could go from $20,000 to $110,000 with really very little effort. So that in description of kind of your annual distributions, go from about $890 a year to $4,722 a year into perpetuity. So that is the benefit of growing your fund and the impact that it can have. Next slide just talks a little bit more about what Susan mentioned at the beginning of today's presentation. And that's the idea of really the goal of inviting our communities to be part of our organizations. And we hear in Holy Mass about bringing the world to its fullness of charity. And charity is the love of mankind. And we have to think the future of our faith revolves around transferring our values to the younger generation, our future priests and religious, our leaders of the home, businesses, and government. And building your endowment and reserve funds now is really about inviting your community to join together and be part of the legacy that will ensure your ministry continues to grow for these generations of future Catholics. So now we talk a little bit about how we can do that. On the next slide, it really talks about how donor services and the Catholic Foundation can help you with fund building. We partner with you to inspire this type of giving, this endowment reserve fund giving. We can do this by helping you with awareness messaging through all of your different communications channels, enhancing awareness of charitable giving tools. We have a lot of giving tools that benefit not only your organization, but the donor through tax benefits, tax breaks. So we have legacy planning, which can be endowment, a named endowment. It could be a gift through their estate plan, charitable remainder trust, lead trust, charitable gift annuities. But two really great options for giving now is IRA qualified charitable distributions and gifts of appreciated assets. And those have really great tax benefits for your community. And you want to make sure that they know that your charity, that your parish, your school can receive those type of funds. We can also, hopefully, as we get out of the pandemic, start offering seminars, in-person gatherings and dinners. We also offer webinars like this for communities where we can talk about the benefits and the case for building endowments. We assist with donor stewardship and training and guidance. And one tip I like to just put out to everyone is why donors don't give. And the number one reason is that they were never asked. So every once in a while you hear from someone that says, oh, we know we have this family that's part of our community and they're so generous to other charities, but they don't give that amount to their parish or their school. Well, have they been asked? Do they understand that there's a need and that their gift could make an impact with your ministry? Or maybe just you haven't asked at that giving level. So that's something that we can assist with as well. On the next slide, I talk a little bit about specifics. We can assist you with defining your needs and your goals. What type of fund would be beneficial for your organization? Endowments, reserves, both. Identifying donors. Have you done a wealth screen? Doing so can help us help you identify some of your people who maybe aren't giving at their full capacity, or maybe you don't even know have the capacity to give at a special gift level. And we can help you invite them to support through a variety of different types of giving, special gifts, challenge gifts, and just general gifts to build your fund. So I am available, setting up a meeting with me, with your pastor, the president, stewardship or finance council members, or any grouping of those, and we can discuss the benefits and how to increase your existing fund or create new funds for you. So feel free to reach out to me if you have any questions. I'm happy to answer them now. If you have any questions specific to your organization, you can always feel free to reach out to me aside from this, and I'm happy to discuss those with you.
Any questions for Madeline? This is a quiet group today. I know many of you personally, and I know you're not this quiet in person. So if you have questions and you just haven't thought of how to phrase them, I do want to let you know that we'll be following up with an email with a link to the recording for this session, but also with the PowerPoint presentation. And that has all our contact information on it for those of you who may want to contact us later with questions, get some ideas from thinking about this presentation. We're always happy to talk to our partners, whether they're current investors or not. And we're just a phone call away. So do feel free to contact us. We're really glad you joined us here today. We hope that it's been helpful. And if there are no other questions, I think we are complete with our webinar on the hour. So we actually met our deadline for you. And I appreciate you all being here. I hope you have a great rest of your Friday and a wonderful weekend. Thank you.
Thank you.
Bye, guys.